Today is April 3, 2:44 p.m. and we saw some unusual options on Marathon Oil. That's MRO. And today it had rallied. You can see this very large gap up today, 10% because oil as a commodity just went up because of this favorable news. So many of these oil companies are rallying up today. Crude oil is also increasing. So this is a sector-wide bullishness, and so we saw these unusual options on this Marathon Oil that we wanted everybody to know about. If you wanted to get in on this bullish oil trade, there is an idea we can propose, and we can also look at that unusual option. So first of all, Marathon, low IV, about just 10%. And we see here the unusual options today. This is here at 11 or 10:11. You'd see here this 2,614 of them. You also see here just at 2:32, actually just about 10 minutes ago. So this 5,000 contracts at the 27 call. So this is June. So very, very recent 10-minute ago trade that happened. And that's why you want to make sure you hit the bell icon so you get notified whenever we see these unusual options. So this is a very bullish 27 strike call. And then these other ones here at the 10-11, you'll see lots of these 10-11s, all for the maize, selling the 23 strike price puts and buying the 28 calls. So this leg, we can analyze that one together. You'd see here, it's this May 19 here, this 8,000 volume. You'll see here, they're basically selling this 23 puts and then buying the 28 calls here. And so this trade, if you analyze it on the profit loss diagram, you'll see that it is bullish. Okay, so the price, which is 26.39 now, as it increases, the profits will increase above the zero line. So with this kind of a trade, though, it is using, in case they are hedging themselves in a way that if it does drop below 23, by expiration date, their loss is still very minimal, capped at this level here at about $48. And that's primarily because of that very strong theta that's going to be helping them, because they sold that 23 puts. Selling those 23 puts cost 2,300 of them. So, and we saw about 8,000 contracts. So that was an 18.4 million buying power options trade that was put on these strike prices at 10-11. And so for this trade, the reason why they capped it at 23, you could see here that right here, we're at $23, $24 here, right? This is the last, on March 31, this was the price. So this big gap up, they don't think it is going to be coming back down. And so if it does, they are capping their, they feel like this is a very strong support line here, that it would not go below that. But there is obviously a probability that it may, and they are trying to reduce their risk by selling those 23 puts. So with our trade, we are going to be doing something different. As you can see, instead of buying the 28 calls here, we sold the 28 calls. And then, so what we did was then we bought the June 20, so we bought also the 24 calls for some of our trades, and we also bought the 27 calls. Because you see here this volume of 7,000, very high, 27 calls. You'll see here, because of that trade that was just done about now, about 20 minutes ago, 15, 20 minutes ago here. This 27 call is right here. So this is the time. And so you'll see that some of our trades we have going for a diagonal trade where we buy the 24s and we sell the 28 calls in May. So that's this. Let's show you that trade. So this is the diagonal of the 24s, and we would then sell the 28s. So this requires $262 only. And you could see here, if we take that off, this is the trade. And it's bullish. It profits as it goes up. And it doesn't require that $2,300 for selling that put. And you could still get a positive theta. It is not a negative theta trade. So that's what we like about this. You can see that the delta here is 34. Vega is also positive, and we have a negative gamma. Compare that to the trade of the unusual options. You'll see here it is here also. This is a 55 delta, a 4 gamma. This is slightly a negative theta, and that's why we like our trade better. Besides the fact that you also save a lot of capital because you don't have to sell that put. Okay. The other alternative is if you wanted to buy that 27 call that we saw over here, it actually costs less, $85. So if you don't want to risk as much, you can buy the 27 calls and then sell the 28 calls. And that's also some of our, that's also here. As you see here, the 27 calls here. So that's another idea if you want to reduce your risk even more. You don't have to necessarily buy the 24 calls. And so by selling that 28 call put, calls, 28 calls, you can reduce your theta decay. And so that is our analysis for Marathon Oil, and let's see if oil continues to go up from here. And so it's a trade that is up to May. Keep in mind there is earnings coming up. That is going to be on May 3. We may have taken that trade off already by then if the profits look good to us. So that is the thesis. So Marathon will be going up. That is our projection, and it would not, this gap is going to hold very strong support here. Okay. All right. Well, give us a like if you like this video, found value in it, and we'll be able to keep making more videos. And subscribe, hit the bell icon, and good luck.